You have now arrived at your destination.
Kyle, this is such a joy to do. I'm so excited for this episode and education that it will be for me. So thank you so much for joining me today.
Harry, pleasure to be on the show. Thank you for having me.
Listen, pleasure's all mine, but I want to start with a little bit on you before we dive into the nitty-gritty. How did you make your way into the world of crypto and investing, and how did Multicoin come to be? Let's start there.
Sure. So I did my last startup in 2013. It was called Pristine. We built software for Google Glass for surgeons. I know Glass was kind of a silly consumer product, but it was a very interesting tool for surgeons because they work with their hands and are sterile and gloved up. Did that, raised venture, grew to a few million in revenue, got to 25, maybe 30 employees. And then Google killed Google Glass, which was a problem for the business, as you would imagine. So after that happened, I pivoted the company, and the company was ultimately acquired for kind of scraps, so no one really made any money. In 2016, I had to kind of find something new to do with myself. I was pretty jaded with healthcare at this point. Try to find something new. I discovered Ethereum in March or so of 2016 started fiddling around with it. And it struck me fairly quickly that this is what permissionless finance is. I had played around with Stripe's APIs maybe a week or two prior. And I was quite frankly not terribly impressed. I was like, you can take a credit card payment. Like, why is this the most hyped up company in the world? But with Ethereum, I started fiddling around with it and I was like, oh, I can do stocks, bonds, equities, I can make things trade. And once I kind of understood the flexibility of all the things you could do with it in one fairly simple language, that's when my eyes kind of opened to what the power of smart contracts could be. Over the course of 2016, kind of spent an increasing percentage of my time reading and learning about the space, falling down the proverbial rabbit hole. By the spring of 2017, I had basically at this point, I was 40 hours a week, internet hobby, crypto. I called up Tushar in May of 2017 and I said, hey man, we should do a fund. Like I think timing is right. Actually the Gnosis ICO was the day that I was like, okay, we got to go. And Tushar was working on his prior startup and also in the healthcare space. And he was getting pretty excited about crypto as well. We've been kind of going down the rabbit hole together. And so in May of 17, we agreed to launch Multicoin. We had no idea how to launch a fund. It took us a few months to figure that out. But got our liquid fund up and off the ground on October 1st of 2017. We added our first venture fund in July of 18. And we're now in our third venture fund and off to the races.
And what an incredible journey it's been. I often find that you actually learn a lot from the hard times. One question that I love is what lesson in the multi-coin journey was the most painful to learn that you're also pleased to have been through?
We cannot be the best at everything. We tried to, for our first 36 months, 24 to 36 months, trade the market and do fundamental research and do venture. And we realized you just cannot do all of the above. And so, we scrapped the trading the market and I no longer look at the prices of anything. We now are 100% focused on thesis formation with our holding period is indefinite. It was a very painful lesson. We made a few trading mistakes that were very, very, very bad. Fortunately, they were not lethal, and we survived and now know what is our strike zone.
Before we dive into the deeper granular, final one before we do that, what does high performance mean to you when I ask you that?
In the context of investing, I think there's kind of a few levels to it. One is building the right culture and organization so that everyone on the team is the right frame and to execute. And then I think the other part of that is your own cognitive performance. And I think that's primarily a function of health behaviors. Making sure your sleep is there, your diet, your exercise, supplements, meds, whatever you're going to do, but being very eyes wide open that your brain is a muscle and that you are training your brain and that you want to be having your brain perform at peak performance at all times.
No, I always find, 10 mojitos always makes that slightly challenging, but I persist anyway. I do want to dive in though. And, when we chatted before, you said to me that tokens are a mechanism to bootstrap network effects, but also to reduce the power of network effects. And I thought that sounded incredibly wise and intellectual, but I wanted to take it a step back and actually kind of ask, and forgive me for the base question here, what actually are tokens? How do they differ from equity? And how do you value them? And I know I sound stupid, but I find it helpful to ask the stupid questions.
Tokens are assets. Assets can be priced. They can be valued. Some assets can have a DCF. Some cannot. Gold, for example, famously does not have a DCF. It's just a function of supply and demand. Tokens are assets. You would hope that in the long run, tokens have some sort of discounted cash flow model that can be used to justify their value. That may or may not be required in the future. And it may be required for some types of crypto assets. It may not be required for others. Those questions are still open. But at the end of the day, they're assets. We spend most of our energy today focused on assets that we believe will be able to produce some sort of discounted cash flow model in the future. However, the thing that's confusing about the crypto landscape in particular is that the largest assets by market cap, notably Bitcoin, Ethereum, Solana, etc., are assets that don't really have an obvious DCF. And so I think that kind of is the source of confusion for many people. As you go down CoinGecko, you get kind of past the L1 platform tokens. Most of the remaining assets, theoretically, you should be able to produce a DCF for.
I've had situations in the past where I'm offered 5 million in equity and 5 million in tokens. And I need to take the token investment to get the equity investment. And I'm never really sure how to think about that. Bluntly, I'm a traditional, really enterprise SaaS investor. And I'm looking at it going, okay, what does that mean? How should one think about that when you're having to buy tokens alongside equity to make the equity investment? Sorry, I'm using this purely for my own knowledge here.
Yeah. In almost all cases, there should not be value accrual to tokens and equity. There are a couple of exceptions to that, but as a general rule, that is true. For teams that try and pitch you value accrual to both, it is almost certain that those two things are in conflict, and that will create a lot of serious problems.
How are they in conflict? Because I thought you had utility tokens which people could use and it made networks better, in which case the value of the token would go up, and then surely the value of the equity would go up because people use the tokens more, and so they're aligned. No?
Yeah, there's a lot of, in the same way that on a capital stack between series A, B, C, D in common, you could have diverging interests. Very easy to have one part of in this case, called the capital stack, so to speak, accrue value at the expense of the other. That is a frequent proposal we see that founders put forth, and we always reject it.
So you want to buy equity or you want to buy tokens?
We generally are token investors. Mechanically speaking, with a lot of the private round market deals that get done these days, they're legally structured as SAFTs, as safes with token warrants, or equity rounds with token warrants. But the primary asset that we believe will have value is tokens. And we do not believe the equity will be worth anything.
Speaking to why you have tokens, just to help me understand, why would it make sense for one company to have a token and one company to not have a token? Because I see a lot of companies with tokens and I'm like, I don't get the utility value of this actually and why you're doing it at all.
Tokens only make sense if you need to incentivize behavior in a permissionless fashion among the public at large.
Okay.
To have them all coordinate on some sort of broader shared objective.
So if we tie that into your bootstrapping of network effects, how do tokens actually bootstrap network effects?
Yeah, so the best way to reason about this is just to look at what I think is the best example of this, which is the Helium network. So the Helium network today is, I think, maybe not 800,000 or 900,000 hotspots. And the Helium network the Helium protocol is a new business model for deploying and managing a wireless network. So if you think today about how Verizon or AT&T or Orange or Vodafone or whatever, how do they build a network? They look at, who has what, they look at the map of the city. They figure out where the optimal places are to put the towers. They call the people who own land. They go build the land. They rent the land. They go build a bunch of towers. They run a bunch of backhaul. It's a very capitally intensive top-down process to do so. There might be some subcontractors involved here, companies like American Tower, but again, those guys are incurring all of those costs. And obviously, it's extremely expensive to get that network off the ground. In the Helium network, the idea is, hey, you can buy a hotspot, put it next to your window. It has an antenna on the back. It creates radio waves. And any device walking around nearby that wants to access those radio waves pays you per byte of data for providing that connectivity. And the goal of this model is, what's great about this model is you physically remove 99% of the cost from the system. So labor cost goes to zero. Land cost goes to zero. Backhaul cost goes to zero. You just physically remove like all of the cost, basically. The only cost that remains is obviously the cost of the hardware itself, which at this point is fairly commoditized. And so with Helium, the goal is to build a wireless network. Now, the thing with a wireless network is a wireless network with 10 hotspots is useless. Like, it's not worth 1/1,000,000th of Verizon's network. It's actually worth zero because no buyer wants to bother to engage with a network that only has 10 hotspots. Sure. Like, it's not worth their energy or effort to think about. So there's some minimum critical mass required before which the network has any value at all. Right. And like, it's unclear what that threshold is. Maybe it's 100,000 hotspots, maybe it's 500,000 hotspots, like whatever, but there's some non-zero number. And so the beauty of tokens here is, if you can tie the usage of the network to organic demand for the token, in the case of Helium, if you want to use the network, you have to buy tokens and then burn them, to use the network. Then if you believe in the vision of the Helium network, let's say you're the first guy or the first one of the first 100 guys to buy a hotspot, you are taking on more risk than the guy who buys the 200,000th hotspot, right? Because it's just much less clear that you will get the critical mass. And so you actually want to incentivize those people to have more financial upside for taking on more financial risk. And the way that the Helium network accomplished that was they issued a fixed amount of HNT per unit of time. And so the first 24 hours, 100 tokens were issued. The second 24 hours, 100 tokens were issued. If there was only one hotspot in the first 24 hours, you got all 100 tokens. Obviously, as the number of hotspots continued to grow, the tokens per hotspot per day decreased, right? There's some algorithm on how that's determined. But this therefore gives a higher financial upside incentive to take on the most risk and build out the earliest hotspots before anyone else believes in it. This is, I think, like the textbook example of using token incentives to bootstrap a network, where you actually are both able to assign risk and reward and couple those things in a real meaningful way, and in which the participants in the network, in this case, the people who buy the hotspots, are actually creating economic value by physically building a new network, right? And competing with Verizon and AT&T. And this is I think a real breakthrough in capital formation, and just wasn't possible before until you had token incentives.
So given that, why does it then actually also reduce the power of network effects? Talk to me about that kind of flip side.
By making it easier to bootstrap any given network than for a network that has theoretical network effects, it is also theoretically easier for the next guy to use the same mechanism to bootstrap a competitive network.
Sure, but actually the lock-in is still the same. No? I mean, if I was suddenly to create a Helium 2, it would be immensely challenging to disentangle the network effect that's been created by the incentive structure that people hold with the tokens and by the commitment to the hardware that they have. It doesn't feel less.
Yeah, I don't think that's true. I think you're going to see in a lot of networks the desire to make 100x on your money or whatever, for doing real work and helping contribute to a real new network will drive a lot of people to try the new thing, just for the sake of trying it. One thing I've discovered is there's a lot more demand for venture scale return, or I should say venture skew of returns among retail than you would previously think. if you don't have to have a 10-year illiquidity cycle. If you can believe I'll do this thing, I'll put some dollars into this, I'll spend energy and effort, I will actually contribute to some greater good, and I have some chance of making 100x in 12 to 24 months, a huge amount of people will partake in that. And this just wasn't an economically viable outcome before. And I think you'll just see radically changing consumer behaviors as the understanding and recognition of that becomes normalized.
With new technologies, you often see actually the opposite of what people expect, which is a concentration in wealth, a reduction in wealth distribution. Do you think tokens do more to concentrate wealth, actually, as we've seen probably in the preceding 2 to 3 years, or do they do more to distribute wealth in a way that I think people envision and hope it does?
Without question, tokens help distribute wealth. I mean, if you look at like tech startups today, like, it's like VCs and employees are the only people with equity, basically. And there are a lot of businesses that like it would have made a lot of sense and could have been quite value accretive to those businesses to somehow incentivize or reward either customers or suppliers or whatever with equity in some sort of more meaningful way. Businesses do not live in businesses have suppliers and customers and partners and whatever. The fact that norms today around business are those parties typically have no equity ownership. I think will be looked upon. I think in 20 years will be looked back as a bug of capital markets regulation, not as a feature.
What are the biggest challenges that companies issuing tokens have in the early days of token issuance? Are there commonalities?
Yeah, I mean, issuing a token is it creates a lot of operational complexity internally. It creates obviously the risk of employees, trading on insider information, and there aren't great tools to stop and prevent that from happening. So that's a real problem. And then just like engaging the community at large, like a startup with 12 employees and you issue a token, and now there's 4,000 random retail people who genuinely believe in what you do and are excited about it and want to help. Like they were banging on your door and they were like, how do I get involved? I can't be an employee. I have a job. I'm not going to quit my job, but I want to support you and help you. When 4,000 people call you, like, what do you do? And it's a very different way to think about growing and creating value and engaging, resources around the world. So like there's the old adage in Silicon Valley of like, if you want advice, ask someone to invest. If you want someone to invest, ask for advice, kind of a thing, right? Like I think that same kind of general thing maps here of like all these people only want to help you because they believe in it enough to put their own capital at work. But once they put their capital at work, they then are really genuinely, they want to help. Again, I think that is a very deeply misunderstood and misconfigured function of existing capital markets regulation.
When I spoke to Avichal, he said in particular from Electric, when it came to tokens, the liquidity associated is both a joy and a curse. How do you think about liquidity within tokens? I'm used to traditional venture where you know it, I know it, you're locked up, you have no liquidity. You can buy and sell whenever you want. How does that change your investor psychology, Kyle?
It doesn't. For us, and the reason it doesn't is we have some basic thresholds for making investments, and one of those thresholds is we will only make an investment if our intended hold horizon at the time of investment is forever. That doesn't mean we can't sell it later, but the thesis has to be good enough that we plan to hold it 10 years from now, given current information. And so in that light, like it doesn't matter at all in terms of our psychology. I think the big benefit it brings is a much faster time cycle of are we good at our jobs or not? Most folks who are 4 to 5 years into their venture career, pre-crypto, had no ability to achieve the
feedback
returns. The returns, yeah, the feedback cycles are much shorter. And so we are fortunate, at the GP level to benefit from that. But that does not change how we make the investment decisions on the margin.
I'm sorry. I'm just naive. When you look at like markets, that are volatile, and you see portfolios down 50, 60, 70%, does that impact your investor psychology, Carl? Do you lose
No.
no. Sorry, it's such a foreign world to me. How do you maintain such a cool head in spite of real-time volatility that is inherent within these markets?
I have a joke I share with our investment team frequently. Prices don't matter if you don't look at them.
I agree. It's just challenging to not look. You mentioned your team there. I'm fascinated when we think about token purchasing, token buying, and then we look at every generalist fund today hiring a Web3 partner. Love it. It takes a fundamentally different structure to really win at this game, in my mind. And as Avichal said on the show, how do you structure your firm? And is it structured fundamentally differently to traditional venture firms?
Well, I've never worked at a traditional venture firm, so I can't comment too much on other firms. I mean, I obviously interact with both analyst associates and GPs at other firms, and I hear kind of rumblings and such, but I've never worked at one. You see how we structure things. A few comments I'll make about how we operate. One, very, very, very heavy focus on writing. Investment memos are the first part. Once we are talking about a new asset, in investment committee, the subsequent 6 or 7 minutes are silent. It's everyone having a bunch of Google Doc comment conversations concurrently. And those are not pleasant conversations typically. Kind of the point is to identify every logical fallacy, every hole, every step skipped, every wrong assumption, and call it out as explicitly as possible. And to do that in a very, very systematic way. I mean, we ask questions too if there's like a valid question to be asked, but it's a fairly non-friendly process. And that's very asynchronous. And so most of our investment memos have 100 comments running along the side of them. And then the actual discussion process from there is, I would guess if an outsider were to watch us debate what we debate at IC, they would find that we get way too far into the details on things that appear to not matter. I find it's very helpful to rip apart a subject from every angle and get into every nuanced detail, no matter how small, and validate my assumption around it. When new people join our investment committee, they are typically flabbergasted at this process. It is not fun. Also, it is extremely not fun. To you write down something that you think is fairly benign, and then I just come and rip it apart. But I think that's what it takes to find the truth. I think the process of actually recognizing the truth fundamentally requires active disagreement. Because the human brain is subject to, everyone has their own biases and whatever heuristics they're using, and as they write a memo, or some of which are inherently misused. And so the only way to actually get to the truth is very, very, very active disagreement.
Does it need to be that brutal, Carl? I'm
Yes.
not one. It does. Why? Why can you not champion and challenge in a productive I'm not saying it's not productive, but challenge in a less fierce way?
I mean, it's not rude. It's just like, you made this statement, and I will just say, this statement is not correct. This assumption is false.
Okay.
Like, what? I don't know what and I believe in the long run, in making all of the members of the investment team appreciate the way they will appreciate next time they will hopefully not make that same logical error again, is by remembering the pain of the prior time, right?
Are you worried that you will prevent people from speaking? If you are a young member of the team, you may be fearful to speak because of the tone and put down that you've seen others be put down to.
It's never put down. It's never. I literally get off investment committee and grab a beer with people. That's not a problem at all. But yeah, you have to have the fortitude to get through it. And like, if you don't have the fortitude, then you're not going to survive in multi-coin.
Has it always
That's
been
also
this
reflected in our, yes. And this is also a reflection of our hiring process. Step one of our hiring process is write an essay better than what's on our blog. I don't read your name. I don't read your background. I don't read your resume. I don't care. I just start reading the first words of your document. And I won't rip it apart, to them, but I'll have a conversation and we'll verbally go through it.
What's step 2 of the hiring process? I love that as step 1.
Step 2 is do that with everyone on the investment team separately.
Can I ask, Carl, if we go back to the token buy-in, when I spoke to Avachal, he said the joy of being a crypto investor in many ways is the collaborative nature, and it's much more collaborative than traditional venture. Do you agree that crypto is more collaborative than traditional venture? And I didn't understand it because he was always saying, we don't need the ownership stakes that other people have. In venture, we can split and have 5% each, 5%, 5%, 5%. And I didn't understand how that actually works, given fund sizes being $1 billion plus. How do you make venture returns in a collaborative ecosystem like I just mentioned?
Well, I mean, mathematically, the only way for that to be true is the outcomes have to be twice as large on average, right?
Yeah.
Which I don't know is like decentralized ownership of stuff justify valuation increase by 2x, 0x, 1x, 8x. I don't know. that is a very good and open question, and I do not have clarity on the answer to that. I generally think it is. It was a lot more collaborative. It is a lot less collaborative now as the fund sizes have gotten larger. Everyone's got sharp elbows these days.
Do you find that?
Yes.
I mean, I have natural questions, but I'm not going to get answers to them. No, I totally get you. Can I ask, on your side, like, again, I'm asking from the naive perspective, but in venture, we have portfolios, we have portfolio construction, you have a number of diversification, like lines that you want to hit. You have capital concentration limits on a per company basis. Do you have the same structures internally within Multicoin of capital concentration, number of companies in a portfolio, reserves allocation? Does it look very different?
We have basically no formal rules of any form of portfolio construction nature. We don't do any notion of reserves in Multicoin. We just deploy it and raise our next fund. And then in terms of, practicalities, we've talked a lot about, like 20% DeFi, 40% NFTs, 30% other new, like you can come up with various diversification buckets if you want. You could say we're going to do X percentage in the Solana ecosystem, Y percentage in the Arweave ecosystem. I've seen a lot of pitch decks that do that kind of a thing. I think it's extremely value destructive to do so because
Why?
You can't know ahead of time what you like. We could not forecast Helium. It would not, if we had any constraints on what is in strike zone or not, then Helium would have been out of strike zone. And we've done a handful of things more recently that, again, like just they would not fit an existing bucket of any form. So I have very strong aversions to sector-centric portfolio construction. You do see obviously stage-centric stuff. We are stage agnostic. We will write $1 million tickets. We will write $300 million tickets, and we will do everything in between. That's obviously not very common, but like we do it. We have no formal constraints in our LPA on that.
When you spoke about the memos and tearing them apart, I was interested because, fundamentally when I look at pre-seed and seed today, I have a very clear opinion that markets change, products change, and really the only thing that will stay the same, hopefully, for the first 24 to 36 months is the founders, and they will guide everything within the business. And so the only thing that matters is the founders. Like, literally the only thing that matters. I've backed many founders who I think have terrible ideas and I hate their companies, but they're brilliant people. And I believe 100% in them. My question to you, is it so founder centric? And how do you think about the importance of market and product in what is a very different world?
Multicoin prioritizes all, I'd say 93% of our discussion time is on market. I would like glance at a couple screenshots of the product, but I don't really care. And founders, I only care that the founder market fit is like makes sense, and they have the, you know, if they're doing something extremely technical, like they need to have obviously the relevant technical background or whatever it is. Cool. But only just care that the founder market fit makes sense. Our belief is that you can reason about market evolution with a lot more precision than I'd say probably most other VCs believe. And that's what has given us the conviction to make high concentration investments in things that other people, that to the extent they were to do them, would have done it at 1/10 the size that we did.
So how do you think you predict markets and analyze markets in a way that's superior to other people bluntly? And also, you know, there are just so many fucking black swan events today, from your COVIDs of your world to your, you know, wars, that are just so unpredictable. How does it work?
Yeah, so most markets you struggle with, and you cannot develop that conviction. It's very difficult. But there are some markets where you can. And the thing we really spend our energy on is like a couple of things. One is, okay, let's assume this thing is starting to be successful. Where are the returns to scale? I think most folks at the earliest stages of investments are not nearly rigorous enough in discussing where the returns to scale come from.
When you say returns to scale is outcome scenario planning, what do you mean by returns to scale?
No, there needs to be something fundamental to the nature of the product and the market, that the product is, every marginal dollar of revenue or usage is getting easier than the previous dollar of revenue or usage.
Okay.
So like the most common way this is discussed is network effects. There are other forms of returns to scale beyond network effects. Network effects are generally misunderstood. We talk about network effects as either sublinear, linear, or superlinear. Or usually the sublinear one is logarithmic almost always. And being very clear about that, being very clear about once the new insight is understood in the world, what are the ways in which there are ways to respond, both by new startups and by incumbents. And again, being fairly rigorous in that analysis. And then the other thing we focus on, in addition to the returns to scale, once you've started the breakout, is, you know, what's the core wedge, right, to get to the breakout point. And again, we just like debate, I mean, again, to painful levels of detail, what are all of the assumptions in the product and in the market? What are the consumer psychology? How are people thinking about this? And do we actually believe that you can establish that wedge and get some sort of flywheel going?
I have to ask, what you mentioned the 3 different types of network effect there. I did not understand one of them, so can you just help me understand what are the 3 different types and how are they different?
Well, sorry, I mean, there's lots of kinds of network effects. I actually think the most important is inclusionary versus exclusionary. But that's a separate one I referenced earlier, which is just either are the network effects superlinear, linear, or sublinear, meaning like as you add each additional user to Facebook or each additional user to the Helium network or whatever, what is the shape of that curve, right? Where the x-axis is number of users and y-axis is like value of network or something like that. Almost all network effects are sublinear. Almost all. But also, like, to understand the degree of the curve, of that logarithmic curve, you can reason about with a lot more precision than most people bother to try. And then in the event whether you think there are superlinear network effects, or at least superlinear for the first part of the curve, that can also change how you think about conviction and sizing. We spend a lot of our energy debating what we think the shape of that curve is. And the more closer we are to superlinear, the more convicted we'll get to size up.
Can you take me to a time when you were reviewing a deal and you said no, because of the network effect work that you did in understanding it, and you were wrong? And how did that change your mindset?
We basically don't do SaaS businesses for this reason. Not like, and I say this as someone who used to be very enthralled by SaaS, but very few SaaS businesses have meaningful network effects. There's obviously some brand effects. There are some SaaS businesses that have a network across the series of customers, come for the tool, stay for the network kind of a thing. That to me is a lot more interesting. But as a general class of thing, SaaS, I'm all of the various SaaS tool things for crypto companies. I don't think we've ever done any of those for that reason.
And you regret it?
No.
Do you get FOMO, Kyle?
Yes, I live in a constant state of FOMO.
Do you try and manage it, or do you just welcomely embrace it?
Let's go. I love
it. Kyle, what's the hardest thing about what you do?
Oh, I think different things are challenging for different people given genetics, biases, skills, whatever. I think for most normal people, if they looked at my schedule, they would just say, my sheer pace of information consumption and redistribution. I do not know anyone who consumes information at a higher rate than I do.
Okay, talk to me about that. How do you choose the information that you choose to digest? In a world of so much information, how do you discover and how do you curate?
So I actually believe that information consumption is extremely inefficient, but extremely effective. And I like fundamentally, look, you can hopefully you curate for the best information and like it's more insightful and whatever and leads you to some new insight or some new deal. But also like you just never fucking know what you're gonna read and where it's gonna come from. And I think that like if you can genuinely consume 3x the amount of information as your competitors, that gives you a real leg up in rendering judgment over time. Where does my information come from? I mean, Twitter is a big part of it. I subscribe to probably 40 email newsletters per day that I read across a range of crypto and non-crypto subjects. Obviously, I read like Tech Meme for my general news to understand what's going on.
Do you allocate reading time? Because I would love to read a lot more, but like you and I both know you get fucking 800 emails a day, and guess what? Your reading time goes to nothing.
I don't read books anymore, but my daily reading time, although it is not on my calendar, is probably on the order of 3 to 4 hours.
And it doesn't get quashed by day-to-day stuff.
I somehow manage a way to do it. I mean, that oftentimes is I am laying in bed reading in the morning or at night. I take phone calls on my Peloton, right? Like so that I can save one phone call to have more reading time later. I'm reading while I eat almost always. There's never a time I'm eating and not reading.
Are you married, Kyle?
I am single.
I was about to say, no wife would put up with that shit.
No.
I was listening to your partner Tushar on a show the other day, and he said something really interesting. I thought he said crypto bull markets were the result of token distribution innovations, and I thought of that, and I was like, really? Is that it, or is it actually leverage and leverage to the extent of 100x? And I wasn't sure. So I'm not casting assertions here, but I'm like, to what extent is it, token distribution innovations versus unparalleled leverage?
The amount of leverage per unit of equity has not meaningfully increased between cycles, to the best of my knowledge. Perpetual contracts give you the leverage you want, like you're good to go. This 3AC blow up is like bad, but like again, the total cost of blow up here is $2-3 billion. I don't know, against the total market cap of whatever 800 billion, it's still not like a huge number. So yeah, it's not that bad in the grand scheme of things. Leverage comes into crypto markets in different ways, some of which is explicit, like perpetual contracts, some of which is hidden, for example, all the CeFi lending, and some of which is harder to identify, for example, ETH being used to fund ICOs, and then ICO teams holding the ETH in their treasuries. And there are other forms of what we call hidden leverage out there, and we do spend a fair bit of our energy trying to identify those, because they're not like strictly quantitative. But that's not what creates the bull markets. What's created the bull markets is, I think actually, at least I should say the last two bull markets has been novel breakthroughs in capital formation.
Do you worry that now, obviously, in a bear market, it's going to be harder to raise funding? Like, do you think you'll see a retreat from institutional LPs away from crypto with the volatility of the asset class?
Maybe, I don't know. We raised right before things turned south, so I guess we got lucky. We are not worried about inability to raise a new fund, but we also haven't bothered to try.
Can I ask, when you look at Multicoin today, what do you think you do fucking well and you're world class at, and where do you look at it and go, I would really like to improve and change that?
Information consumption coupled with like extremely rigorous debate over the nature of markets. I think we are best in class at that. In terms of where areas we want to improve, I would like to figure out how to do what we do at a larger degree of scale. I am of the view that it is not possible. However, I would like to be convinced otherwise.
What do you mean it's not possible? Because Avachal said on the show that token buying at scale is so hard. Why is it not possible?
Specifically, I believe that the core unit of an investment firm is the investment team. And I am of the view that if an investment team is larger than 10, you are now net value destructive to the overall investment team process and culture.
Why? I don't disagree with you, but why?
People do not get enough discussion time. And like assuming all of those people are in fact out scouting deals and hunting deals, and then you're coming back to IC, like assuming they're all producing whatever X number of deals per week, well, like IC would just now become 6 hours of the day. And like, there's just like some like upper bound limit to like the amount of time you can spend as a team reviewing decisions versus time spent collecting the information to make them.
And that's what many firms are, 6 hours of ICs. I'm totally with you. Do you think people feel the same pressure then to bring deals to the table? Obviously, we both know many VCs. They feel intense pressure to bring deals. Do you feel that pressure? And in your world, is temporal diversification important? How do you think about speed of deployment?
We don't care about speed of deployment. Our view is we do it if we love it. And like, besides that, whatever. The solution to almost all problems goes away when you just, I do it if I love it. Yeah.
I agree with you. Have you ever not loved it, Carl? Everyone has troughs. You ever not?
Oh yeah. I mean, we've done a bunch of stupid shit that I look back on and I'm like, oh, why did we do that? We do a quarterly decision review, looking back on decisions from the prior year, both in our hedge fund and our venture funds. And the primary purpose of that is really, if things have gone wrong since then, like, could we have forecasted that, right? Like, was there something we missed in our analysis? Some form of risk we did not identify that was plausible to identify at that point in time. And then the other thing we really, really focus on in those decisions is, if we did something, did we size it correctly? And I think VCs don't spend nearly enough energy on this. It's always easy to undersize. And did we? Were we too cautious?
What do you mean? Did you size it correctly? And it's always easy to undersize. You're talking about the actual cash injection and size of your position.
Yeah, correct. It's always easy to say, it's risky. I want to do 10 million. Now we're going to do 5. It's risky, whatever.
But you always wish you had more in your winners and less in your losers. What do you actually learn from that sizing thought process?
Well, again, it's okay. It's been 18 or 24 months. Have the nature of the network effects been what we thought they would be? If they were what we thought they would be and it's working, then we should have sized up, because that means our assessment of the nature of that network effect curve was accurate. Now, we have some confidence interval going into it ahead of time, but like that should give us more confidence in our ability to have a more narrow confidence interval around the next what's called network effect kind of curve we're constructing.
When you got it wrong, how often were they knowable elements that caused it to not work versus unknowable, unpredictable elements?
If we look across, call it 80 or so companies in our portfolio that are now old enough that you can have done this analysis and have had some time pass, off the top of my head, of the ones that had something, go meaningfully wrong, which percentage were in the knowable versus unknowable camp? Probably half were in the knowable camp and half were in the unknowable camp.
Is loss rates the same in your world?
No, they're much lower.
And why are they lower?
Time to liquidity.
Help me understand this.
I mean, there's a lot of things that, like, tokens launch, they trade at a price that's 2x, 4x, 8x, whatever you're right. And like, it's been 18 months since you made the investment. You're convicted your thesis was wrong for whatever reason, and you get to get out. It's very rare in non-crypto venture that you have a chance to get out at a multiple of 2, 3, 4, 5, 6, 8x 18 to 24 months later, while you genuinely think that you were wrong with some hindsight.
Sure. And you can do that in your world?
Yes.
Does it not signal negatively if you, Multicoin, are selling a big block? Does that not negatively signal and cause challenges?
It does. And like, we always talk with the founders and understand from their perspectives, like, hey, what's working, what's not working. Like, they will know, are we happy or unhappy with how it's progressing? And then if we are going to sell, like, we do it in a responsible way. So we're never like, we will TWAP over 6 months, like, we're not going to get out in 2 weeks. Yeah. That's irresponsible. But we can happily TWAP over 6 months. We have one position we've been TWAPing for a year.
Wow. Okay. Yeah. That is different. I get you. Listen, Carl, I want to move into my favorite, which is a quick fire. So I say a short statement. You give me your immediate thoughts. Does that sound okay?
Let's go.
So reading wise, you said about your information ingestion. What was the last piece of content that blew your mind?
Eugene Wei, not status as a service, but the path dependency of social graphs. I forget the name of the blog post, but that one.
Is Bitcoin a hedge against inflation?
No, Bitcoin is nonsense.
Why?
It does not. There are so many ways you can choose to have a productive asset or a non-productive asset. And then there are many assets that are naturally good hedges against inflation. The obvious of which is like Walmart and Amazon. People do not want to own unproductive assets. There's no reason to own them because they are not productive. And there are plenty of ways to get inflation-resistant assets that are not gold, or in this case, digital gold.
Why does Solana beat Ethereum?
Ethereum does not have a scaling plan 7 years later. It still does not have one today. I do not think they will have one in the next 12 months. Predictability around a scaling plan is by far the most important thing. It's not just you need to say we scale as of this current moment. It's that everyone else in the outside world needs to believe that you have a plan that will persist over a meaningful period of time, and they need to believe that plan. Ethereum has no such plan. They've never have, and I do not think they will.
Why?
Because they choose not to. They choose to focus on heterogeneous experiments, which are fine, but they create confusion. And then they just choose to make they choose to build according to their ideology of what they want to build, as opposed to what the market actually wants to use.
What makes a really great plan versus an average plan?
That's a good question. Specificity. I like specificity in plans.
So as granular and as deep as possible.
As possible, given the nature of the form of risk and nature of the activity involved.
Does that really inspire confidence in the community? And what I mean by that is, like, if you are super specific and super granular to the mass consumer public buying Solana, they're buying it on their, whatever neobank they're buying through your Coinbase or whatever. They're not reading the plan. Does it really actually inspire the confidence, or is it just
The
in
customer
this
of a
type
blockchain is not retail. The customer of a blockchain is developers. Developers do care.
Fair. What piece of advice do you often give but find hard to follow, Kyle?
Make sure you work out every day.
Tell me, what do you know now that you wish you'd known at the start of your time with Multicoin?
There are a lot of things that I think will be stupid in 3 years, but I think will be interesting in the next 12 months, and I need to be more open-minded about those things.
How do you try and keep an open mind? Because I find it hard in venture. You see something that doesn't work. Fuck, healthcare never works. It's not doing that. And actually, something could work in healthcare.
Yeah, it's tough. I mean, I try and be an optimist, but I don't know. I mean, that's a very difficult question.
Penultimate one. What would you most like to change about the world of crypto?
I would like clarity around a set of regulatory requirements around capital formation that are pretty close to laissez-faire.
Are we close to that?
No.
What do we need to happen for that to occur?
An act of Congress or some change in the rules from the SEC.
Final one for you, Carl. What's the most recent publicly announced investment and why did you get so excited?
I think our most recently publicly announced one is Delphia. I think it's on our blog. Delphia is a data DAO, which is really cool. So the idea, right? People talk about like, oh, Facebook and Google monetize your data, and oh, you should like be able to be compensated for that. I kind of think that's stupid. The compensation Facebook and Google give you is the utility of their respective services, and it turns out people like those services. But there is value in data, and in particular, there is value in aggregating data. And there is some subset of people out there, not everyone, but like 0.1% of the population or maybe 0.3% of the population that is particularly intrigued by the idea of monetizing their data in a much more interesting way. And so the idea of Delphia is, hey, go to your Amazon account, go to your Google search history, go to whatever, LinkedIn, export your data, and then upload it to Delphia. And Delphia will use that information to trade US equities. And so obviously the hope here is that like you can forecast earnings of companies with much more precision by aggregating a bunch of consumer purchasing data that was not otherwise previously possible. I mean, in particular, you can look at influencers. You can have a sense of identity across various channels that is not possible to do with credit card data. And then you can use a lot of short-dated call options to run over market makers and produce exceptional returns. That's a theory at scale. And so our hope is this is kind of like the ultimate manifestation of like Robinhood, right? Like, where you can contribute to the new thing.
Carl, I have to admit, I've never felt quite so naive. You remember, I normally interview VCs, and I know VC. This has been an education and a joy. Thank you so much for joining me and for putting up with my incredibly basic questions.
I don't think they were basic at all. I thought these were great. Token network effects, bootstrapping networks. This is awesome. So, Harry, thank you for having me on the show.